Hello, this is Kopi Time, podcast series on markets and economies from DBS Group Research. I'm Taimur Baig, Chief Economist, welcoming you to our 156th episode. Today, it's just me, yours truly. I have a few things to cover. I will go over trade war. I will talk about the Middle East and the U.S. economy, and all of this with the second half of 2025 in mind. And then I will address some questions from you, the listeners. I sent out a call on LinkedIn and on WhatsApp, gotten a bunch of questions back, some from clients, some from general public, and some from colleagues in the DBS. I'll take on as many as I can, and here we go. All right, first, the trade stuff. So the reciprocal tariff pause is coming to an end soon. Question is, how's it going with Asian exports and exporters? Well, emblematic of this episode, there's a great deal of concern and fear, but life goes on. Asia's exporters are negative about the outlook, but for the time being, they're hunkering down, doing whatever they can. As soon as Donald Trump was reelected last November, an exacerbation of the trade war was guaranteed. From January onward, shipments to the U.S. began to jump as traders tried to get ahead of whatever restrictions were coming down the road. But regardless of such efforts, the early April announcements were so much worse than expected that PMIs dived sharply across the region. The aggregate PMIs of ASEAN 6, for instance, are now down to levels not seen in years. But that doesn't mean the poor sentiment has translated into poor numbers. Through April, ASEAN 6 exports growth was an uptrend, marking a sharp divergence from PMI. So PMI is going down, exports staying up or holding up pretty well. We now have May data for China, India, Malaysia, Korea, Taiwan, Vietnam. And what do we see? Well, in most cases, we see exports doing pretty well. There's some slicing and dicing of the data needed to be done. Let's go through that momentarily. Think about a country like Vietnam. A third of its exports go to the U.S., and they have major vulnerabilities if this 46% reciprocal tariff were to come back after the pause. But through May, Vietnam's exports were up 17% on a year-on-year basis, and their exports to the U.S. up 36% on a year-on-year basis. I can come up with data like that for many countries. Taiwan, I think, for the month of May is up like 87% on a year-on-year basis. So PMI readings are suggesting that this is not going to last. People are basically advancing a lot of exports in anticipation of worse tariff environment, and therefore we'll have a big payback. But for the time being, that divergence is persisting. And then look at the contrast with China. China's exports to the U.S. are contracting sharply, but its overall exports are up. So you combine Vietnam's data, exports to the U.S. up a lot, China's data, exports to the U.S. down a lot, but both cases, exports to the whole world up still pretty nicely. Then you can think of four types of conclusions. First, as I said earlier, a lot of front-loading type trade is taking place to get ahead of the tariffs. Second, in the Chinese context, clearly a lot of things are going from China to other countries to make their way to the U.S. I mean, this is the old China plus one transshipment story. I think the Americans will try to crack down on that, but so far, that narrative is still very much alive. Then there is this thing that many countries outside the U.S. worry, which is if the Chinese can sell a lot to the U.S., they will start selling even more at even cheaper price to their countries. So the excess capacity ending up in non-U.S. parts of the world, surely that is also part of the dynamic. And the key point is, even though these export numbers are decent, they will maybe a mirage or a chimera. It will not last. If you think that the end of reciprocal tariff pause would be marked by big, beautiful agreements with the U.S. and many other countries, I think you'll be disappointed. I think we're not going back to pre-Trump days or even pre-January days in global trade. Restrictions will be substantial. Watch for trade numbers to follow sentiments, not the other way around. So that's our key message. It's not going to last. All right. Now, let's talk about the Middle East, which unfortunately has been commanding the headlines for all the wrong reasons. And the uncertainty is considerable. All sorts of really terrible scenarios can be conjured. You don't really need to work very hard at them. And that spectrum of extremely adverse outcomes to say adverse outcomes, the market seems to be sort of coalescing around the less adverse, it's all sort of going to work out, not a big deal sort of scenario. Pretty impressive, I got to say. Looking at the movement of risk assets so far, we find the market's response centered on our expectation of a short duration conflagration. It'll end with a severely weakened Iran, and highly emboldened Israel. Quite a bit of facilitation from the US. But I suppose the market is taking its cues from previous episodes of conflict. Look, there was an Iraq-Iran war for 8 years in the 80s. And then there were lots of disruptions to oil and gas supply production at that time. But that didn't really bring us the 1970 style oil shock. Similarly, when Saddam Hussein was withdrawing from Kuwait in 91 after the U.S.-led coalition sort of drove them back to Iraq, they set on fire oil field after oil field. There were spectacular, scary dystopian images coming out of Kuwait, sky-high plumes and raging fire. But even then, if you look at the oil price chart from the 80s and early 90s, you'll be able to not be able to find out when these events happen. Oil prices went up a little bit here and there, but not at a time, in a big manner. And now we're talking about 2025 when the supply side of the oil market is ample outside of the Middle East, whether it is the U.S. or the Gulf, Mexican Gulf, U.S. Gulf, whatever you call it, or Latin America. Ample energy being produced in that part of the world, and the demand is fairly muted. So I suppose that's why the likelihood of a big oil rally is not, being at the core of the market's expectation. Now, while hoping that the market's view is the right one, that no oil shock is about to transpire, it is important to recognize the criticality of the conflict-afflicted region at stake. Iran sits at a global choke point of energy supply, disrupting which remains in its arsenal of options. We hope they don't use it, but it's definitely something that the Iranians can go for. Gas and oil, crude or refined, these are all shipped from ports of Persian Gulf to the narrow Straits of Hormuz from a number of countries: Bahrain, Iran, Iraq, Kuwait, Qatar, Saudi Arabia's East Coast, all of this stuff, and of course the UAE. About a fifth of the world's oil consumption passes through the Straits, and all of Qatar's LNG exports, the number one LNG export producer in the world, exporter in the world, that goes through the Straits as well. So most of the energy flowing from this region is bound for Asia. So Asia's vulnerability is definitely substantial. Now, I said earlier that it's certainly one of the options that Iran can choose to pursue, but let's also put it in context that there is a very substantial U.S. military presence in the region. U.S. has a large Navy base in Bahrain, a large Air Force base in Qatar, and in the last few months, it has moved even additional soldiers, weaponry, ships in the region. So the U.S. will certainly get in the way of Iran if it indeed tried to do substantial disruption to oil supply in that part of the world. So the desire to keep oil prices from spiking and keeping U.S. allies secure may lead to some degree of conflagration that we're not really pricing in. That's my fear, that if indeed Iran tries to do something like that, American troops might get deployed in numbers not seen since the war against Iraq. So Donald Trump may only have recently given a speech about his desire to keep U.S. military involvement out of the Middle East. I don't know if the odds of that is very, very high any longer. Once you have started going that path, all sorts of developments can force the U.S.'s hand in getting more involved in the region. So I keep those risks in mind. First, the Iranians' existential needs would include the option of disrupting the Gulf of Hormuz, Straits of Hormuz, and B, that could draw the U.S. into far deeper involvement in the region, contrary to what Donald Trump has decided to impart on his followers in recent years. So let's talk a little more about the U.S., but not necessarily in the context of Middle East, but in the context of the economy for the second half of this year. Now, we've had incessant noise this year: wars in the Middle East, on again, off again tariffs, highly disruptive immigration tightening measures, wide range of other things Donald Trump has done, including going after schools. This sort of noise typically should have disruptive impact on the markets and the economy. But if you look at the year's report card so far, of course, we had substantial volatility in April, but beyond that, it's been a remarkably calm year. Now casting estimates from the Atlanta Fed is now pointing to real GDP tracking 3% plus growth for the second quarter, which would put the first half of 2025 growth in the 1.5% or above territory. And this is after a virtually flat first quarter, in fact, slightly negative quarter-on-quarter seasonally adjusted growth. And the financial markets, they have made up for the losses that were incurred after the April 2 reciprocal tariff announcements, with both NASDAQ and S&P in positive year-to-date territory. Now, survey-based data reflected acute uncertainty and stagflation fears initially, but they've begun to ease lately. St. Louis Fed's Economic Policy Uncertainty Index is still highly elevated, but it is down from the panic-induced peak reached a couple of months ago. University of Michigan's survey of consumer sentiment and inflation expectation surveys are also showing that the peak fear is behind us. The risk of this feel-good moment being a temporary one is non-trivial in my view, from an oil shock emanating out of the Middle East to belated but inevitable inflation pass-through from tariffs. Several developments are on the cards that could undo the marginal improvement in sentiments that are visible at this juncture. And also, there are some positive mitigants as well. Put aside the funding issue for a second of U.S. fiscal balance. Just put aside that for a second. But the fact of the matter is that the big, beautiful bill would come with a big fiscal impulse for the U.S. economy. There's going to be a series of tax cuts, and whether you are convinced that they're funded or unfunded is a different story. They will add tailwind to consumption and sentiments, no question about that. So this could be a potential offset to the potential negatives at play. Now, you could argue that the tax cut will be largely oriented towards the wealthy, true, and they tend to have lower marginal propensity to consume, true, but it would still support domestic consumption. Be sure about that. So does that mean that there's a need to upgrade GDP forecasts? We are forecasting 1.5% for 2025. The IMF is forecasting 1.8%. Consensus is somewhere in that region as well. I think that there is a growing chance that growth might be higher than our 1.5% forecast, but we don't think that this is the time to change the forecast. As we heard from Chair Powell during his June FOMC press conference, there are way too many uncertainties out there right now to make a decisive call on economic momentum and the path of inflation, especially as the trade and fiscal policy environment is beset with frequent escalations and about turns coming from the White House. There are also other reasons to be cautious. Immigration measures and public sector employee firings offer a multitude of risks. On immigration, the ongoing crackdowns will hurt labor supply and cost in a number of sectors: farming, fishing, shipping, construction, transportation, recreation. Coming during the summer months when both farming and construction reach their high season, this may play out actually sooner than later. And then on the DOGE side, there was a lot of firing, cancellation of funding, et cetera. They are beginning to show up in the data. If you look at public sector's contribution to payrolls, it's the weakest in a decade, weaker than Trump 1.0. And this is particularly in contrast to the Biden years, but even contrast to the Trump years. Interestingly, by the way, this is not just restricted to the public sector. The private sector is also showing some loss of buoyancy. It's still positive payrolls growth, decent numbers in six figures, but no longer in the 200, 300 range, more like 100, 125, 50 range. So if public sector job cuts meant meaningful improvement to the fiscal position, then at least you could argue that there's an upside. There's a huge amount of debt, huge amount of deficit. These firings and cost cuttings are a necessary evil, one could argue. But however, despite all the noise around defunding foreign aid, public broadcasting, research, and education, it turns out that the fiscal needle is not moving at all. Burdened by ever-rising interest payment costs, defense spending, as well as Social Security and entitlement spending, public expenditure in the U.S. remains on an upswing. Through the third week of June 2025, federal government spending was up 7.2% year-on-year, compared to less than 1% growth during the same period last year. So let's put that 7.2 and 1 in the real terms, right? Adjust for inflation. Public spending in the U.S. was falling in real terms last year at this time. Public spending in the U.S. is rising in real terms this year, robustly actually. So we see three key drivers of economic slowdown ahead. One is labor supply crunch due to mass deportation. Second is rising cost of production, both due to labor crunch as well as tariffs. And then third, the slowdown in the non-AI investment sphere due to uncertainty around trade and investment policy. I'm again fearful that might again show up sooner than later. Moderation in company margin and profitability is on the cards, and the legal blue-collar workers may see their wages go up because that's the part of the market that will tighten. The outlook for a wide range of white-collar jobs is actually becoming quite gloomy. So not only are we not going to change our 2025 forecast to 1.5%, we'll keep it there, conceding there might be a little bit of upside risk. We're actually worried that some of the things that we just talked about in terms of downside risk, it'll actually spill over to 2026. So we're going to actually revise down our 2026 forecast to 1.5% as well. So we are in the non-recession camp. We have always been there. We have not yo-yoed between non-recession and recession. We've always been in the non-recession camp. We think the U.S. economy will continue to grow, but we're very much in the sub-trend growth camp for both 2025 and 2026. What does it mean for the Fed? They'll cut rates. They'll cut a couple of times this year. They'll cut a couple of times next year. Can they cut a lot more? I suppose it depends on the trajectory of inflation. We think that above trend inflation is something that the Fed will look through, argue that this is a one-off. Tariff will go away, the base effect will fade in the subsequent year, and they will cut rates just on the back of real economic weakness. But there's a limit of how much they can cut if indeed inflations remain fairly sticky. And my concern is it will. It'll be way higher than 2.5%, both in 25 and 26. Okay, now some questions from you guys. Jiten, number of questions. So he has a number of questions. I'll have to provide a bunch of answers. How long can the U.S. keep increasing the debt? The short answer is it can do it for a very long time. 100% debt GDP ratio is something that the U.S. can handle. It's an uncomfortable number. Paying 5% of GDP in interest rates is no good. It crowds out a lot of other investments. But a country that basically issues debt in its own currency can push up debt GDP ratio substantially more. There's no technical barriers to that. Even if the market doesn't like it and pushes up interest rate, that doesn't prevent the U.S. from issuing more debt. I'm going to talk about various mechanisms that can come around managing that debt a little later. In fact, the next question from Jiten is that under what conditions it can afford to do it? Well, let's talk about the really good scenario that the Republicans are hoping and praying for. It can keep going under a strong growth scenario. If indeed Trump's tax cuts and the AI revolution that is underway, all these things lead to a big investment cycle, productivity growth, above trend growth rate, 2.5%, 3% growth year after year, then all of a sudden these deficit numbers won't look that scary. Growth alone will take care of it. And also, if things don't go that way, the U.S. government can do what the Japanese have done in the past. The U.S. government can do what the Indian government has used to do in the past, force the central bank to buy more debt, force banks and other financial institutions to buy more debt, put ceilings on interest rates, target yield curve, all kinds of stuff, right? It's something novel. Markets will not be happy to see those things, but they will not be shocked by it because other countries in the world have done it. And then there's always good old QE. So there are many ways one can think that this party can go on. Now, Jiten's follow-up question is, what can lead to an inflection point? Well, you could think about forget about the Liz Truss moment. I don't think that sort of bond vigilante attack on the U.S. is not that likely. U.S. have to do lots of things wrong to do that. And having somebody like Scott Bessent as Treasury Secretary, I personally don't think that U.S. is going to go down that path. But if we want to talk about inflection point, we can talk about election-related risk. November next year is the midterm. If early polling is the marker for what is coming 15, 16 months from now, the House will be taken over by the Democrats, perhaps also the Senate, and that would be policy paralysis. So if we go in there with really bad fiscal dynamic, and then between the president and the Congress, there is a standoff and nothing gets done, then we could have a big inflection point, and we might have to have some sort of shock therapy in the U.S. where debt ceiling is not breached or there's no agreement on that to extend that. The market goes on a strike. All sorts of bad things can happen at that point. So I would sort of watch out as that as a marker for inflection point or some major risk around debt deficit situation. What do all these things mean? Would it raise or impact the base rate yield expectation from U.S. Treasuries over the long term? Well, base rate, not as long as Trump is around. I think the dovish bias in the U.S. central bank will be substantial. Otherwise, Trump will create so much noise. So I don't think the Fed is in any position to push up the base rate even under this sort of debt scenario. And then on the longer end, yeah, the curve can steepen for sure. There is only so much that the market can absorb if the U.S. keeps on issuing year after year 5-6% of GDP worth of deficit, especially if the rest of the world becomes concerned because a chunk of U.S. fiscal debt is funded by the rest of the world. And then Jiten's follow-up question is, how will it impact global bond markets? Well, we could see a situation where the global bond holders don't necessarily go on a strike in terms of not wanting to hold US dollar bonds. They still would want to. It is the most liquid, largest bond market in the world. It does offer attractive yield. People will keep investing in it, but that may be the stock story, that I'm not necessarily going to reduce my stock of US Treasury holdings, let them run their course. But in terms of flows, I think people will display a great degree of home bias. European money managers would like to buy European bonds. Japanese money managers would buy Japanese bonds. Australians would buy Aussie bonds and maybe look around Southeast Asia as well as look at the West. So that sort of stuff is certainly on the cards, and it's not in the long term. I think it's playing out as we speak right now. Next question is, what are the alternatives for investors to look at as diversification without increasing the risk significantly? Well, I think there are many things investors can do in terms of not, being fully focused on the U.S. exceptionalism story, which has been the case for the last 15 years. Time to sort of look around a bit. But I don't think looking around means embracing risk. I think buying European bonds or Japanese bonds, Australian bonds or Singaporean bonds do not add any risk to your portfolio. You might give a little bit of yield, but on a cross-currency basis, I think it's still pretty attractive. So that would be one. To look at non-US dollar bonds. But corporate credit, same story. There are lots of excellent US companies which issue debt at an attractive yield. I would buy that sometimes over US bonds if one is sort of so much worried about the US Treasury outlook. Similarly, there's outstanding companies around the world with very good cash flow, and they issue attractively priced bonds as well. So I would look at corporate credit, highly rated corporate credit, non-US bonds, and of course the usual spectrum of things like gold, which is having this golden run, but certainly there is no harm adding some gold as a hedge to all the geopolitical uncertainties we have. Gold tends to do very well in these uncertain times. We've seen in the past, we're seeing it now. And that's the reason, despite real rates being positive, gold remains a core part of many portfolios and will not be given sort of scant attention. It'll receive substantial attention. All right, Jiten, you asked lots of questions. Thanks for that. Appreciate it. Frederick's question. Can you speak a bit about U.S. Treasuries, please? It seems to me that the bond market in general is undergoing fundamental changes. So what can I say to Frederick's questions that I have not said already? Well, first of all, if you look at the Financial Stability Survey that the U.S. Fed issued last October 2025, there was an interesting point there that bond market liquidity is not what it used to be. Regulations after the GFC change, the banks, the kind of bonds that they can have, how much of it is hold to maturity, how much of it is mark to market, all those things change quite a bit. And now what we see, and in that financial stability survey, the Fed makes that observation, is that what is known as off the run volume, that immediately after issuance, how much secondary market trading happens with those bonds is not particularly high. So if indeed there are events during which sellers are out there in large numbers, they have a hard time finding buyers, and that could create large spreads or large movements of price in a very short period of time. So that risk is there. So earlier I was trying to be fairly cognizant or complacent about the risks in the U.S. Treasury market. The U.S. can keep issuing. It can do all sorts of financial repression type measures by capping yields and stuff like that. But we can also have situations where things happen very quickly, and around that yield spike, or people have a hard time settling their accounts. That sort of risk is substantially there. And maybe one way to solve that going forward would be to go back to the GFC prescription or the pandemic prescription, which is go back to QE. The Fed has done quite a bit of QT. Its balance sheet has come down quite a bit. GFC levels, it'll never happen. Ample liquidity is something that the market expects coming from the Fed. And if indeed we are going to see some degree of stress in the Treasury market, the Fed, although it is independent, its focuses on unemployment and inflation, but it will not want the markets to become unstable. So under the guise of financial stability, we can see the Fed come in and working there. So that is the main point. So there are some fundamental changes that have taken place in the U.S. bond market because of regulation. And those regulations may have to be undone. Maybe the U.S. will have to let banks and financial institutions hold more and give them good risk ratings so that they do. All right, so then what else is there? What is the future of Southeast Asian sovereign debt? Presumably, we will see fiscal response to the worsening global outlook, but after the pandemic, fiscal room is limited. I wouldn't worry too much about it. I think that there is decent fiscal room in Southeast Asia. Southeast Asian countries, maybe Thailand could be one exception, but I think countries like Philippines, Indonesia, Malaysia, Singapore, certainly have ample room to issue if they needed to. I don't think there is massive concern in these countries to make up for a shortfall in external demand through fiscal pump priming. These countries are not that preemptive in this regard. They will do it if the shock becomes visible. So whether it is trade or investment, things don't look that bad. Given the amount of noise we have in the world, Southeast Asian economies are pretty much holding up. But just in terms of the issuance outlook, yeah, they'll issue more. They don't need to go on a big debt-funded binge. They have ample savings. Their current account balances are good. Domestic savings ratios are high. So developing domestic capital markets, focusing on more buoyant equity markets, all those things could help, in addition to helping the sovereign debt issuance to take place in a stable manner, tapping into domestic capital and maybe some regional capital. You don't have to go all over the world to market Southeast Asia's debt. There's enough savings and interest among insurers, money managers, sovereign wealth funds in Asia, in my view, to fund Southeast Asia's sovereign needs. And I'm definitely a buyer of sovereign bonds from Southeast Asia, even at a time like this. But just one caveat, which is that if a country is sort of expanding its deficit because it has an ambitious growth agenda, it has to sort of convince the world that it is going to do quality spending of that deficit. Otherwise, people will start demanding a higher risk premium. So quality spending, stable regulatory environment with respect to tax, capital repatriation, bond pricing, bond trading, all of those things are, I think, quite important if a country is indeed thinking about widening its sovereign issuance and wanting global investors to hold it with enthusiasm. Question from TC, my former colleague at DBS. In the face of uncertain trade and economic outlook and a steep USD curve and real rates, how would tight Asian credit market perform from here? I think Asian credit market can stay rich. I'll tell you why. I think that there's a bit of an illusion in the credit market, which is that if I get 5-6% yield, I'm happy. Even if US yield is 4.5%, I don't necessarily need 200 basis point pickup from that. It doesn't make any sense. It should be that spreads should be constant, but it seems like as US rates go up, spreads contract. Investors seem to be happy in mid or slightly higher than mid-single digit yield. And even if the US is in mid-single digit, it doesn't change their view that much. And as a result, we see spreads compress. So if the US rates hang around at 4-ish, we will see spreads remain tight in Southeast Asia for institutions that offer 5.5-6% yield. I don't see that going away anytime soon. And as the Fed starts cutting, I think the long end is not going to be coming down as much as the short end. So I think this situation would likely persist. And yeah, I think that Asian credit remains rich. Not everything. I mean, we all know that property developers in China or some banks here and there are some trade war related risks. There's some property sector slowdown related risk. All that is pretty well understood in the market. But the highly rated bonds that have rallied substantially in Asia, I think they will remain so. Question from Ken. Where to invest at a time like this? Well, I think we've touched on that already, but let me just go through it again. If you are a Singapore dollar investor, you should buy Singapore dollar bonds. Don't quibble about the fact that it's yielding 200 basis points less than the US counterpart. From a currency perspective, your purchasing capacity is increasing because Sing dollar is strengthening substantially these days. I think Sing dollar foreign bonds for single dollar investors is just fine. And as I said earlier, home bias is fine around the world these days. Japanese buying Japanese bonds, Europeans buying European bonds. Gold, same story. It's a risky, uncertain time. Well, wholesome gold, wholesome good quality equity. But that sort of takes me to the longer end of the discussion. For example, I'm not a outright seller of U.S. equities. I find U.S. equities very expensive, but I think they still offer attractive return for the long term. So if you're thinking about the short term, some bonds, some gold, but if you're thinking about the long term, certainly Asian equities, European equities, as well as U.S. equities would offer you superior return on a risk-adjusted basis in a 5-7 year scenario. So don't neglect stocks just because you're very spooked by the short term. In the long term, those things always do pretty well. And coming back to that credit part, when I was answering TC's question, U.S. corporate credit, maybe you don't want to hold U.S. government bonds, but U.S. corporate credit, I think, is actually in some ways less subject to political risk than U.S. government bonds. So they are very, very attractive as well. Then Keith has some thought-provoking question. What is one economic megatrend that not enough people are paying attention to? Keith, I will tell you something that needs a lot of time to go through, but let me take a little bit of time today, and maybe one of these days I'll do a bigger, longer podcast on this issue. One thing that people are not recognizing is how expensive innovation is becoming. And by that, I mean not just AI stuff. We see all this, tens of billions of dollars going into AI-related work. All the Metas and the Googles of the world are spending shockingly large amount of money. Same with the Chinese. I'm not just talking about that. I'm talking about if you want to do innovation in pharma, in green technology, in quantum, in graphene, in life sciences, you would have to spend billions of dollars. So the days of just lots of smart people coming together and coming up with innovation, fortunately, is behind us. Ideas, by and large, are getting harder to find. It costs a lot of money, and it requires a lot of scientists to come up with breakthroughs. And if you think about this a little further, that actually means that productivity from innovation is actually not that easy to extract, because innovation costs much more today than it did 10, 20, 30 years ago. So there are a bunch of people who have written very interesting papers about this. I myself have written a paper on this in recent years, but I still don't think this is very widely recognized. And what is the upshot of this point? Well, what does it mean that ideas are getting more expensive? It means that unless you're a very large or a very rich economy, you probably will not be in the innovation game going forward. It's just going to be not feasible for you to have thousands and thousands of scientists and billions of dollars on a single field to come up with innovation. China can do it. US can do it. I suppose Europe can do it too. After that, the list gets very, very thin. So I'll leave it there. It's a big issue, lots of aspects to discuss, but that's, I think, one thing that is not very well recognized. Second question from Keith is, what are the conditions for Southeast Asia to be a more integrated market? Keith, Southeast Asia is a very heterogeneous region. Large countries, small countries, thriving democracies, some not quite so, some very comfortable with China, some more comfortable with the West. So that heterogeneity sort of gets in the way of the region becoming very cohesive. So I think that the region needs to sort of build on the Regional Comprehensive Economic Partnership, RCEP, and sort of recognize that even if we're never going to have political union in the region, we could sort of start heading toward some sort of a United States of Southeast Asia for trade, capital flows, and movement of labor. If those three things we could sort of improve upon without necessarily going the European Union route, I think it would be very beneficial for the region. On goods, the region is still already sort of pretty united, and inputs do free pretty seamlessly within the region. But we need engineers, we need capital also to move through the regions more seamlessly. That'll really, really help. And also recognition that the region has a lot of common interests. It may be a heterogeneous region, but it has common risks. Climate change, disruptive technology, great power competition. This region is affected by all three of those. So I'd like to see small countries like Singapore, large countries like Indonesia, mid-sized countries like Malaysia all come together in recognition of these major generational risks. And hopefully that, again, takes us to become slightly more integrated, and that certainly would be helpful. All right, final question, nothing to do with markets, nothing to do with geopolitics. Ranil Salgado, IMF resident representative in New Delhi, has sent in, what is a recent movie that I should see and why? Ranil, simple answer. Go watch Mission Impossible Final Reckoning on IMAX. Do not watch it in a plane. Watch it in the biggest screen possible with the best sound. We don't have action heroes anymore. Tom Cruise is part of a dying generation. Watch him in his glorious stunts. The plot doesn't make that much sense, but it's a cool AI plot nonetheless. It's engaging, it's gripping, it's long, but it is totally worth your money. Go watch that. Okay, we're going to wrap things up. Thanks to our listeners and viewers. Kopi Time was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. All 156 episodes of this podcast are available on YouTube, as well as on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.